Why is Bitcoin down, but gold just hit an all-time high? There is increasing divergence that we can see between gold and Bitcoin and increasingly NASDAQ. That has important signal for what's going to come for Bitcoin. Hi, everybody. This is Sina from 21st Capital. Today, we're going to go over another Bitcoin intelligence report as part of our premium videos for our subscribers. Today, we're going to talk about the price action, valuation, and the divergence between Bitcoin and gold and NASDAQ, and some seasonal patterns that are very interesting for the month of August and September. And we're also going to look at the Fed rate cuts and the latest PCE inflation report that was published last week. All right, so let's get into it. Let's have a quick look at the price action. August was not a good month. Bitcoin was down about 6%, and it ended the month with another sharp drop. It fell below 110K, which is creating a lot of pain for people who had entered at above these values in the last several months at above 120, 124. Lots of investors came in, and now they're underwater and they're under pressure. But the drop seems to have slowed down, at least in the last several days. We'll see what happens next week. My guess is that it will be a very volatile week. And at the end of that week, we also have the labor market report, which is going to clarify many things about the recession odds and the rate cuts continuation and so on. But we can also see that Bitcoin has gone back to its power law average trend line. This is, you can think of this as a fair value metric. Whenever we are above that, we are in a mini bubble, which can go on for some time until we top. And when it's below, it typically catches up. We have been following this line for years now, and Bitcoin has, in the last 3 years, it has just flirted with this up and down. Right now, we are almost at the fair value, and for long-term investors that are doing dollar cost averaging, this is a fantastic value. Looking at our Bitcoin Quantile model, we can also visualize the range of historical values that Bitcoin has seen, all the way to very overheated danger zone to the frozen zone, the bear market bottoms. We are sort of in the middle and a little bit actually towards the lower side. As you can see, Bitcoin has tried for the last couple of years to get into this yellow zone, and every time it has been rejected. And it has essentially for the last 2 years been stuck in this green zone. From valuation standpoint, somewhere between 33rd and 66 quantiles, which historically have determined 1/3 of Bitcoin price action. We've now spent 1/3 in the frozen zone, 1/3 in the green zone, and then we'll see what happens moving forward. And this would almost be the median where we are. We are at 56 quantile, which is almost our median price point. And if another leg up comes towards the end of this year, we should be seeing pretty interesting values moving forward, and that would even not be in line with, not even closely similar to the high exuberant periods in the last cycles. So moving on, I talked about a divergence, right? So it's very important. Something that I've noticed in the last few years is Bitcoin is not purely following NASDAQ. It's also not purely following gold. The correlations are imperfect. But when you look at both of them, it's kind of like Bitcoin sometimes follows this and sometimes follows that. And whenever it's not following NASDAQ, you can see it's following gold. So it's kind of hops on this or the other, with very few cases where it actually diverges from both, but then it quickly catches up. One of those great examples of that was the first peak of the 2021, where we saw Bitcoin initially go up with gold and NASDAQ, but then at some point gold stopped growing and went down. Nasdaq went down, but Bitcoin kept going up, created a bubble, and then had to sharply correct back down. And then when gold and Nasdaq started another run up, Bitcoin follows them to the second cycle peak. But gold quickly stopped growing and stagnated. Nasdaq and Bitcoin continued and caught up to the downside. And from 2022 onward, from half of 2022, they have been very much correlated, actually. So gold had a bounce here, and both gold had a bounce here, and both Nasdaq and Bitcoin also had a bounce. Then they all continued going down with little bounces. As you can see, they all together do these bounces. They bottomed together, they moved up together, but then Bitcoin and gold decided to go sideways, but Nasdaq started running, which indicated a bull market is probably coming. And these two with a delay caught up. And they've been going up together, sometimes all together, but sometimes with small breaks. Here, actually, Nasdaq keeps going up, but Bitcoin starts to do a long consolidation and a slow bleed. This kind of matches what gold did with a stagnant price action. So I would say Bitcoin is now following more gold more a little bit, but you could be seeing Nasdaq running pretty strongly and with a correction, and then again very strongly upward. Bitcoin finishes this consolidation and then follows Nasdaq upward. And then at that point, gold becomes to stagnate, but then Bitcoin starts to follow Nasdaq. They topped together after Trump administration came in and talked about all the tariffs. Nasdaq crashed, Bitcoin crashed, but gold did not. Actually, gold diverged from both and went up, and ultimately had an all-time high. And as you can see, Bitcoin and Nasdaq also caught up pretty quickly. Except we are saying right at the end of this move, we are saying Bitcoin is coming back down by more than 13% on an intraday basis. But gold just hit an all-time high, and Nasdaq had a very mild correction, still right there at near all-time highs. You can look at this closer. And again, you see the same pattern. Bitcoin and gold and Nasdaq have been following the same path together. Then gold starts to go the other way, but Bitcoin joins Nasdaq. Then gold starts going up. Bitcoin joins Nasdaq to go down. But ultimately, again, they catch up altogether. So it's important to realize that Bitcoin is sometimes following gold and sometimes Nasdaq, but at the end of the day, the three of them catch up over time. So this kind of this move downward could indicate that maybe Bitcoin is sniffing something that the other two giants are not, but in my opinion, it's more likely the other way, meaning money supply is increasing and gold and central bank reaction and other traders are positioning into gold, and Nasdaq is actually not much down, just slightly down from the all-time high. But Bitcoin has had a few major whales selling and also just has to absorb the recent all-time high. A bunch of sell forces have emerged lately, but they have nothing to do with the large, longer-term trend. So it is very likely that as the monetary expansion happens, and more liquidity is unleashed into the market and deficit spending continues, Bitcoin, this will all find its way to Bitcoin, and first off, slow down this bleed and do some price to lead to some consolidation at price action, and then it will catch up quickly with both of them. Although remember, this chart is not the scales are different, so even though Bitcoin seems to be following the same path as Nasdaq, for instance, its returns has been multiple times more. So something to consider. I'm very interested in this divergence and see which way it resolves. Another super interesting pattern that I visualized this week was the monthly returns of Bitcoin over its history. I was trying to see if there is a clear pattern, a clear monthly pattern. You see things are kind of all over the place, but when you look at the averages, very interesting patterns emerge. For example, if you look at the median of all the months from when we have data to 2010 all the way to 2025, the median on a median basis, you see that October has been the worst month with a median of 8.6% decline. In most cases, 2011, 14, 15, 16, 18, 19, and the last 3-4 years, August has been a terrible month. There has been some exceptions, which are actually distorting some of the averages. So, which is why I look at median for this analysis more than the average. But also you can see a pretty interesting change from the long history to the recent last few years, especially with the appearance of institutions and ETFs and all the other Wall Street players. The chances that seasonality changes and matches Wall Street a little bit better goes up. Aligned with that, we do see that September, for example, has been historically also a very bad month. In fact, it's been the second worst month if you look at the whole history. But in the last 5 years and the last 3 years more especially, September has been a solid month, returning 5.6% over the last 3 months. So in recent years, it has only been August that's performing negatively. And after that, you usually see a September that ends the correction and actually finishes the month with a 5% increase. And then that leads the market to very, very positive October and November. So the October is very real. You can see that October actually has been very, very green across history, and certainly in the last several years, it has returned 15% across the whole history. But if you look at the last 5 years, it has returned 20%. Last 3 years, the same, 20%. November also has been a fantastic month in the last 3 years, returning 23%. But it has been less interesting if you look at the whole history. But overall, seems like, at least based on seasonality patterns, September should be a much better month, and it should lead us to typically positive October and November. And from that point on, it's many months of gains according to seasonal patterns. And generally, another month that shows weak performance has been maybe around March. But things are a little bit all over the place here. In the last 5 years, for example, you could see that May has been really, really bad. The sell in May and go away mantra has been true, but this hasn't been the case in the last 3 years, actually. So if you combine everything, it does seem like in the last 5 years, at least, we start the year pretty strong. Then in April, it gets weak. In May, June, and July, we still have some less than great price action, depending on what happens in particular years. August ends up being the worst, and then you get another peak towards the end of the year. So it does seem like after October, so from September and then really, really after October all the way to the end of spring, we see good price action. Maybe mid-spring we see positive price action, and then summer is generally not good. So pretty interesting. And if this is the same thing happens this month, September onward should be really good, and this will also match the start of the rate cuts from the Fed. One of the most important data points that we saw that would impact rate cuts odds was the PCE report. This came in line with expectations, both year over year and month over month, exactly as expected. And we do see that PCE is very slightly ticking up. matching what people expected from the effect of tariffs, but it's not enough to change anything. It's a very small amount, so the rate cut odds are the same, and it's very likely that September cut happens. However, everything depends on what happens on Friday with the labor market, because we've had 3 terrible months for the labor market in the past, but this next report will clarify whether that trend is continuing, and if that continues, it will be very scary for the Fed from a recessionary standpoint. But I'm also considering a very interesting scenario, which bad news ends up being good news for the market, because markets have been deprived of liquidity because of high rates. And if labor market shows weakness, that's not terribly shocking and recessionary, but rather medium or low level of weakness, that could actually solidify the rate cut trend that we might be seeing moving forward. And the market is only pricing 1 cut in September and not much more afterwards. But if that happens, many more rate cuts will be priced in, and this might actually end up being positive for the market. Most likely scenario is a weak labor report initially leads to a drop because of fears of recession. And then as the Fed comes out and confirms that they're going to ramp up the rate cuts, everything will recover and much more. So this is our macro and overview section of the report. We have make sure to read our full report. That will cover on-chain data by Wizard and liquidity and monetary plumbing by Renault. If you want to read our weekly reports, sign up on 21stcapital.com to our Bitcoin Intelligence product for weekly analyses, charts, and videos like this. Our on-chain and our monetary mechanics section, they also have their own videos that are published for our premium subscribers. Thank you very much, and I'll talk to you next week.